want people to make money, but we want people to be able to afford the American dream. And that means companies can't rip off consumers anymore, not in President Trump's America.
And there you have it. Director Pulte looking presidential. And this man knows all about looking presidential. Taylor Stork, good to see you, my friend. You've had quite the last few days in and out of the dentist chair. You went to the eye doctor. What a run you've had.
Yeah, and I just realized that I kind of have a similar haircut to Director Pulte. I need to get a little tighter on the sides, I think, maybe.
Hey, he looked good, man.
Yeah.
I thought he did a pretty good job, given the fact that he's been under a lot of scrutiny and a lot of criticism. What did you make of the press conference? And just before we get into the nitty gritty of what was said by the FHFA director regarding VantageScore, and there's certainly a lot to unpack there. What did you think about the delivery from him, the fact that Secretary Turner was by his side?
Yeah, well, I'll tell you what big picture, I have been following the housing industry as it relates to policy and politics for a very long time. And one thing I will say in this administration, this particular administration, there has been a bigger, stronger, much more vocal focus on housing than I can remember in years. And that is refreshing in and of itself. The idea that the director of HUD and the secretary of HUD and the director of FHFA are standing on the stage side by side, making joint announcements. I mean, I don't remember seeing that before. So it's refreshing to see that. It's also refreshing that they're on the same page insofar as they can be with regard to some of these policy changes and initiatives, because it gets really disruptive for housing and particularly finance and housing when one side of the administration, whether it's HUD or FHFA in the housing space, does a change that the other side doesn't implement. And now lenders have to try to figure out how to navigate a bifurcated model. And so I'm glad that they are working to align things. Did
you just catch that there's somebody in my hotel room?
I did. And I decided to do my best to overlook it. And
I think it may be housekeeping. I'm not sure what's going on here, but yeah. You like my gathering sweatshirt?
I do. I like your gathering sweatshirt. I went and there's still somebody, by the way, back in the back. I'm going
to pretend like my room is not being robbed right now. Okay.
Yeah. I went to my Neiman Marcus account. I didn't see that sweatshirt there. So I'm going to have to figure out, is it available at christianlouboutin.com or where?
It's at gregsher.com. It's at you'reoneofmybestfriends.com. Yeah. So of course I have one for you.
Cool. Good. I can't wait to put it on.
Yeah, I can't wait to give it to you. And I'm excited for the gathering, which kicks off later today. And then, of course, we'll have some really incredible panels. We'll be talking about the credit conundrum, if you will, with Zactus. Very excited to be up on stage. I understand after my session that Secretary Turner is going to be hitting the stage. And it's going to be the first time I've been followed by a government official. So first,
I don't think that's true, Greg. I hear that there are special agents following you around all the time.
You know what? I don't want to know if there are. Let me just tell you that. All right, so let's get into the message that was conveyed and some of the details. We're in business. That was the message from Director Pulte. VantageScore is here. Seller guides are being changed. There's been $10 million already closed in just VantageScore. And they're going to be delivering that to the secondary market. According to Director Pulte, Will Lansing, the CEO of FICO, called him on his way to that press conference to say, please let us play ball. Let us be in the game. We'll lower our price in one of the respects, one of the channels to 99 cents. I looked at that and said, progress. Like even the fact that Will Lansing called him, right? A guy that has essentially thumbed his nose up at the mortgage industry while hiking prices 1,800% over the last handful of years, while making anywhere from 30 to 60 million a year, while his stock price, and their profit margin is 30+% most years, while the bureaus are around 10 to 12% respectively. I looked at all of that as the needle moving. Now, plenty of detractors came out and have written since This was nothing. This was no big deal. Nothing has changed. Really irked me. I didn't really see eye to eye with those people, and I'd love to know what you think.
Well, I don't know how you can say nothing has changed. We're going to add a new scoring model to a system that hasn't seen a new scoring model in ever. So that's kind of a change, a little bit, I think. I definitely think something has changed. The introduction of a new scoring model. I mean, look, this isn't going to suddenly make the Earth switch its tilt on its axis. We're not going to see the sun rise in the west and set in the east. But it begins to alter the dynamics, and we will begin to see residual effects after the fact. It's not going to happen today. It's not going to happen tomorrow. But to your point, within minutes of the conference being ready to happen, you saw an offer to massively change the pricing model from the FICO side. Now, keep in mind, that wasn't an offer on the current FICO Classic. That was an offer on the to be approved and released FICO 10T. And that wasn't an offer for a massive discount from the current $10 down to 99 cents. That was an offer to provide a success-based model where if and when you close that loan, you then pay another $65 per score per borrower. So theoretically, two borrowers, $195 times two, 300, and what is that? $390.
Well, are you prepared to go on record right now to tell us how that pencils out? Did Pulte just pull another okey doke on the HFA director? Is he offering real benefit, or is he raising the prices under the guise of coming to the rescue of the industry? Because the last time he did this to Pulte, he went from $4.95 a score to $10 a score and sold it as the next great thing.
Yeah, he's a good salesman. And I will go on record as saying that it will be 99 cents and it will be a success fee of $65. And the reason I can go on record is because FICO has posted that on their website. And it's only for 10T, which is not yet approved and released. Now, I will say that the next step that needs to be done is 10T needs to be brought to market. There's no reason not to, that I know of. But bringing 10T will bring a more advanced FICO model to market. I mean, think about it. We're using a FICO model that's 20 plus years old. And 10T will add in trended data, and it'll add in some of the same things that Director Pulte was speaking about on the conference, rent payments, maybe some utilities. Now, keep in mind, only about 10% of landlords, maybe even less than 10% of landlords currently report rent. But that is one of the initiatives that's buried inside of the Road to Housing bill, trying to get the corporate landlords to commit to always reporting rent activity to the bureaus. So, there's a lot of moving parts here in order to modernize the entire space.
Pulte did really lean in on the rent aspect that more Americans should be given credit. I agree. Yeah. I don't understand why it's just 10% or less that are factored in. And I'm wondering if there's anything the government can do to mandate that that's reported in to the bureaus.
I think it's hard to mandate that things are reported in. I mean, they're attempting to do that with the current housing bill and the carve-outs that they're offering for the corporate landlords. But still, even with that, I mean, corporate landlords own less than 1% of all housing stock nationwide. It's like 0.00 something. So it definitely would have an impact for those people that sit in that, slice of the pie, but it's not a huge, gigantic needle mover. Now, remember, FHA loans and other VA loans, we've long been able to use rent payments to enhance a file, to add compensating factors and things of that nature. So this is not a new concept. It's just new that it's being added into a scoring algorithm. That's really the thing that's changing. And remember also that neither Fannie Mae nor Freddie Mac use the number from the scoring algorithm to approve a loan. So it's not going to make a loan get approved. Fannie and Freddie have very sophisticated black box technology algorithms, that are looking at the credit characteristics of a file not reliant on a third-party company that has a sophisticated math score for which they charge a royalty fee. They use their own analysis to decide if a borrower is creditworthy, and the addition of a rent history into a scoring model, what that ultimately impacts is the pricing. Ultimately, everything that a score, whether it's a FICO score or a Vantage score or the Greg Sher score, all that does is impact the pricing, and the pricing is in the form of LLPAs for the two GSEs, right? So ultimately, GSE revenue, and it is in the form of valuations that are issued by the bond traders, whether MBS or MSR, and how those bonds are digested and then remunerated. So it's a sticky wicket. But I hope that people don't think this means that suddenly more borrowers are going to be eligible for conventional loans, because the scoring model doesn't change eligibility.
But if you look at what VantageScore has been saying, it is that 30 million or so more people will, I guess, have a score above 620, if I recall correctly, something like that. And of that, about 5 million will qualify for a loan that they don't qualify for today.
That's technically inaccurate, though, right? Because, again, Fannie Mae and Freddie Mac don't use the FICO score or the Vantage score to issue a DU or an LPA approval. You've had loans come in since a few months ago when they eliminated the FICO score floor that were approvals below 620. I've had loans come in that were approvals below 620. So the idea that you have to have a 620 threshold is quickly kind of becoming a thing of the past, which means that a scoring model that's going to magically get you in because you can now get more people scored over 620. The only place where that actually really holds water is if you're talking about particular lenders that have FICO credit overlays. And there are plenty of aggregators that have various credit overlays.
So there are obviously still a lot of loose ends that we need tied down here, right?
This is the mortgage business. All we have in this business are loose ends. We thrive on them.
It's amazing the amount of human capital that has been tied up in this conversation. Mm-hmm. Not just this, but the single pool, which we'll talk about in a minute. And somebody, National Mortgage News, called me earlier. We were having a conversation. They were looking for comments, and they asked me what I, as a lender, was hoping to get out of this. And I thought it was obvious, but I said, lower costs for credit, lower cost to the consumer. But then it dawned on me, there's no guarantee that by the time this is done, that it will cost any less than it does today for a credit report. We'll just have more options. Yeah,
it's not going to cost less. There's no way it costs less, because let's just all stop pretending that we live in, fantasy land for a few minutes, and this is Oz. The bureaus are publicly traded companies, and FICO is a publicly traded company. Full stop. And what that means is that the executives have a fiduciary responsibility to return a profit to their shareholders. Whether we like it or not, whether our industry likes it or not, doesn't really matter. If the CEO and the executives don't return that profit, the shareholders kick them out and get new CEOs.
So what are we doing this for? Why are we putting all this effort in thinking that we're solving a cost problem when at the end of the day, we may end up with the same cost or more? What problem are we solving?
That's a great question. And I wish that the people that race off to solve problems would once in a while ask that question before racing off to solve it. I also wish that those same people would ask a big room full of people what everybody thinks, because one of the things about our industry is we have a lot of diverse opinions, and sometimes both opinions can be right at the same time. And I know that sounds a little weird and awkward, but sometimes both opinions are right, and it just takes different angles and different perspectives to understand why one is right in its way and another is right in its way. We don't do a good enough job of promoting discourse, promoting constructive disagreement, and accepting the point of view of others and finding space for multiple opinions. We just don't do it. We don't do it well. In our industry, there tends to be this all or nothing tribalism. We're right, you're wrong, and if you're wrong, then I don't like you, and so forth and so on. And it's unfortunate because it tends to put us into positions in camps and camps of opposition from one another that is just unnecessary, because at the end of the day, we all want the same thing. We just want to put people in homes.
I remember Bob Brooksmith, the president and CEO of the NBA, talking about the idea of a housing czar. Dave Stevens, prior to him, was the one that talked about it first. It just seems like there's always this feel like there's nobody inside of the Capitol, inside of Washington, that really understands housing very well at all. Do you get any sense that this moment is different? Do you feel like there's enough acumen there now to affect change?
I think there are plenty of acumen and acuwomen to affect change, and I think that that's an important distinction without a difference. Yeah, there we go.
That was excellent.
Okay, thank you.
My question. That was good.
Yeah, your question. As you know, I have great respect for Dave Stevens. God rest his soul. He introduced the two of us. It happened to be over discussion about some of these same topics that we're here covering right this minute. And I firmly disagree with his concept of a housing czar. I think it's a terrible idea, and I will stand behind that and say it over and over again to whoever wants to tell me it's a great idea. I just don't think it's a good idea. We have a Secretary of Housing, and I think he's doing a good job. He did a great job on the conference. We have a regulator that oversees Fannie Mae and Freddie Mac. Housing's covered. What's a czar going to do? Covered, like, be on top of those two people?
Well, I think that what a czar would do would take your idea that we need to be talking more, maybe coalesce the industry around these ideas and conversations, then pick that up and take it to the White House, to Congress, to the House, to the Senate, and have these conversations and kind of speak on behalf of the industry. Right now, I guess the NBA would be that voice, and CHLA. Is it enough, though? Of course, you're the president of CHLA, Community Home Lenders of America, and you guys have been extremely involved. And I should say that we are members, and very proud members. We get a lot of bang for our buck. It's like no other bang for our buck that we get. We have a real seat at the table, so I want to thank you for that. But my question is still the same. Do you feel like there's enough housing intelligence inside the walls there to get things done?
Well, then my answer is going to be the same. The president of the United States grew up in the housing business and housed people and continues to do so. I don't know if you've ever been to this little tiny town called New York City. There are buildings all over New York City called Trump buildings. Mm-hmm. And I think there might be a few in other places also, the last time I checked.
Well, and the Pulte name is certainly one pretty well known in the housing space.
Pulte, yeah, there's I think they build houses maybe. So yeah, I would say that there's some fundamental base knowledge of housing in the White House right this minute. And to suggest that we need to have some expert that's going to speak for everybody all the time at the same time, it contradicts the concept that I said earlier, which is that debate is healthy, discourse is healthy, and you don't have to have one single position that dominates everybody else and is right all the time. It's fundamentally the reason that we are a democratic republic in the first place. It's why we set up checks and balances between the executive, the legislative, and the judicial branches of government. It's so that multiple opinions can be heard and considered and balanced, and people can find middle ground, not just these all or nothing, do it my way or you're wrong kind of models. And I think that Director Pulte and Secretary Turner expressed that very well during the conference that they held 2 days ago, when they said that they don't care what score is used. They're not looking to pick winners and losers. They just want to add scoring to the system, scoring options to the system to create competition. And I think that's healthy. I agree.
And I would say there's enough in there now.
Yeah. Well, I don't know if I agree. I would love to see Fannie Mae and Freddie Mac develop their own models to project creditworthiness of transactions.
Well, let's dive into that, because something that's being overlooked that I think was the most critical thing said during that press conference by the director and the secretary was what Director Pulte said around AI.
Yeah,
I don't know if you caught this, but he dropped it right there. He said that where this is moving with AI. Essentially paraphrasing what I heard him say was, we're up here right now talking about competition. We're introducing competition into it, but all this is a bridge to the new world that we're lightning speed heading to, when we're not even going to need a score because AI is so good at predicting ability to repay. Did I hear that right?
That's what I heard also. And I think that there were some, subtle overtones and undertones and subtleties and all of the things, but I think there is truth to it. The challenge we run into is permission, right? So the bureaus have to give permission for somebody to use their data, however you're going to use it. Greg, you have permission to use the bureau data to make a credit decision for a mortgage. You do not have permission to take that same data and go make a credit decision for a car purchase. You can't do that. In fact, you don't have permission to publish your results if you do an analysis on your data. You don't. So the permissible use of that data becomes a factor. And so with that said, if you want to go create credit algorithms within NFM, you can do so. And you could apply that to NFM loans. And you could say, this loan's a 10, this loan's a 2. But you don't have permission to do that for other organizations. And you don't have permission to do it on something other than a mortgage.
So I didn't understand everything you just said. I want to be honest with you. How funny is that? That's just the relationship that we have, that I can say something like that. I mean, let's not that you didn't make sense. It's that I'm not sure I've got the intellectual bandwidth to pick up everything that you were dropping, but dummy it down for me. What I heard him say, you said, I heard, and you heard the same thing.
Yeah.
We're heading to a world where AI is going to be able to be more predictive, and potentially we're not going to need scores. Can't something be built where scores are no longer necessary, or we get a different kind of score? It's no longer about FICO or Equifax or Experience or TransUnion. It's, this borrower's ability to repay based on all the data we've collected, including rent, is an 8 out of 10. And maybe the standard is 7 out of 10.
So I do believe that analytics are going to get much more sophisticated because of AI. I do believe that our ability to build analytical models is going to get much more sophisticated because of AI. The challenge that we're going to run into is that AI needs data to build these models, and the data has to be, we have to have permission to use the data to build those models. And I'm not sure the legal process and the contractual process to get there.
Can't they get the data from somewhere else? Can't the government generate the data? Why does it have to come? Why does the data have to? I'm really dumbing it down. But educate us all. Like, why does the data have to come from the bureaus? Why can't there be more bureaus?
Well, that's a great question. There can be more bureaus, and one of your friends and mine wrote a beautiful article talking about the need for more bureaus.
Is that Kobe? My buddy Kobe?
Mm-hmm.
Yeah.
There were some good points in that article. Yep. And more bureaus, more sources of data would certainly widen the field. Look, here's the bottom line. I don't think there's any scenario where more information about a loan makes it a worse loan. I think in almost all cases, more information makes it a better loan. We can have more clarity and more accuracy on the borrower's ability to repay. I think that anytime you're talking about reducing the amount of information we have on a loan, that does, as a lender, that doesn't add up for me.
Well, how about just having different weights? Like, for instance, if someone's been on a job for 15 years,
sure.
To me, if they're borderline DTI, that pushes them over the edge to an approval. Or if someone has 2 years worth of assets, or if someone has been putting money into their 401k since they were 35 years, all that shows characteristics of somebody that's responsible.
I agree.
Yeah.
And there are 2 companies that have built beautiful analytic models to evaluate those very things. One of them is called Fannie Mae and the other one is called Freddie Mac.
Okay. And
that's my point. So so you actually just inadvertently brought up something that's really interesting. You brought up the
Well, God forbid I bring up something really interesting on purpose. You have to give me like the backward hand, accolade there. It's fine. I'll take
no. You
take
did it inadvertently. My point is, you're so interesting.
50%.
You brought up something interesting by accident. That's the point that I was trying to make. You're accidentally interesting.
Okay, continue.
The point that I'm trying to make here is that you just named a bunch of characteristics to make a loan for a borrower that have nothing to do with their credit report.
Right.
And that's the reality. The reality is somebody's ability to repay is based on those characteristics more so than any others, not based on a algorithm that was created 20 years plus ago, before a lot of this stuff even existed, long before we had an internet and AI, long before we had a housing crash, right? The way that we make loans is we evaluate the likelihood that the borrower is going to continue having income to pay us back. And the continuity of income is not considered in a credit score. The credit score is backwards looking. I mean, it makes a bunch of assumptions, and it tells us what your past behavior has been that theoretically can predict your future behavior. But we all know that there are plenty of very creditworthy borrowers that have a death in the family, lose a job, have some sort of cataclysmic medical situation, and that those are the things that will mean that people stop paying their mortgage, more so than anything else.
I agree.
Yeah, and a credit score can't predict that. Credit scores don't predict job loss. Credit scores don't predict, health catastrophe, death of a primary income provider in a family. Credit scores can't predict that.
Yeah. Well, you and I, let's go back here and talk more about something that we've beaten to death, but that the NBA has also beaten to death, that would potentially move the needle on cost initially, and that is the idea of going from a tri-merge to a single pool, which the NBA continues to be a very major proponent of. The CHLA, your organization, has come out against that. There have been a lot of papers that have been written, including one by AEI and Tobias Peter, which the NBA actually cites as supporting their argument for a single pool, when Tobias told me right here on these same airwaves that a single pool is not a good idea and that there's too much risk involved, and inherently people will gamify and you will end up with higher LLPAs, and end investors, bond buyers and such, will pay less for the lack of predictability around the single pool than the tri-merge. Any idea, any opinion on why something that seems like it's not going to happen can't just die already? I know you have ideas. The question is, are you going to say them right now? That's the question.
Yeah.
How far are you going to dive into that pool? Are we getting in the 4-foot pool, the kiddie pool? Or are we going right off the diving board and doing like a somersault, cannonball? Let's go cannonball. Come on, Taylor.
So here's what I think from a very high level. I think that in the midst of adding new scoring models, that alone is going to create a new level of uncertainty in mortgage at the agencies. And I think that now would be the wrong time to go experimenting with other new novel ideas, whether it is a single bureau or a portable credit report or some new thing that somebody comes up with. I think that it's important to maintain stability in our housing market and our housing finance system. And I don't think it is prudent to experiment with new ideas right this second. Okay, that's number one. I think it's destabilizing. I think that the most important thing we can do is get Vantage up and running and to get 10T up and running and create some new choice options. And I think we need to watch and see how that plays out over the next year or two. Okay.
What percentage possibility do you give it that a single pool is going to go through, that's going to be a thing?
I don't think there's a good chance.
You almost said zero. I saw you go.
I don't think there's a good chance. And I'll tell you why I don't think there's a good chance. And it has nothing to do with the mortgage industry. It has to do with Fannie Mae and Freddie Mac. If you add new risky processes to approve loans, the people that invest in Fannie Mae and Freddie Mac, if Fannie and Freddie were to do some sort of new public offering or some sort of endeavor to monetize the government's share of ownership, adding new risk into a model that isn't in there right now would be destabilizing and would put the concept of monetizing Fannie and Freddie at risk fundamentally. And so that's why I don't think it's likely.
It would also diminish their coffers by what Tobias estimated with me is about, I think it was 8%.
Yeah.
8% of the revenue that the GSEs drive in through LLPAs, which would cause them to raise LLPAs. And we know how hard it is to get anything done. And so imagine the proceeds being less, those shareholders you referenced getting less on their returns. And now they put the LLPAs at a heightened level. And how do you unwind that? How long would that take? But you still didn't answer my question. Do you realize that? You avoided my question.
And you've complimented me for my ability to avoid your questions in the past.
You're doing a great job. Good job, Taylor. You're doing a great job.
Thank you. I appreciate that. So I think that the biggest concern is a non-mortgage concern. It's a capital markets concern. And just remember that in order for Fannie or Freddie, without amending the PSPA, in order for Fannie or Freddie to exit conservatorship, they have to gain a certain amount of capital. Ironically, the capital is dictated by the average FICO score in their portfolio to begin with. So there's an irony for you, right? But they have to put together more capital than they have today. And the way you make capital is by retaining earnings. And the way you increase earnings is by charging LLPAs, not making loans cheaper. So
back to the questions you didn't answer. Why do you think that the NBA can't let this go? Is it because it's the best idea they have? Or is it because they really have conviction in what they're saying? Because the industry has spoken very loudly here. I did a poll myself. I polled nearly 500 people, which is a good poll. That is a good, solid poll. The margin of error is not huge there. And 57% of people in our industry either said no or they don't have enough data to know whether to say yes or no. That's a majority right there. So I'm not going to have you answer that question if you don't want to.
I'd like to say something about that though, Greg, if that's okay with you. So first of all, I would argue that it's a little aggressive to call it a majority, because I think that the set of people that said they don't have enough information, I would argue that they're basically abstaining, right, without not participating in the poll at all. But what I would say is if you pull those people out and you look at the number of people that either are pro or opposed, it's like 60% pro, 40% opposed, right? If you pull out the abstains, if you pull out the not enough information. And this goes back to an earlier comment that I made. I think that debate and discourse is healthy, but I don't think it's healthy when a slight majority of people make decisions on behalf of the entire industry. I think it's unfortunate that there are probably a number of people in the opposed camp of your survey that are very intelligent, very prominent thought leaders in the mortgage business that have put a great deal of consideration into this. And what really disappoints me is that these two camps haven't been able to come together and hear one another's positions. And when I say hear, I don't mean debate. I mean literally understand where the other person is coming from and why they feel the way they do about their position. I get the idea. The idea is that companies are losing a ton of money because they have to pay for the credit reports that they didn't close. And if they could cut that amount by a third on a segment of loans, then companies would save themselves $1 million a year or whatever the numbers. I get the debate, and that's a valid debate. The theory that this is going to somehow save consumers money, I struggle with that one, but I understand the concept with it. But I struggle with the idea that it's going to save consumers money. And the reason I struggle with it is because you might save $100 on the credit report by only having one bureau, but we don't know what kind of pricing is going to offset that only one bureau credit report, right? So we don't know if there's going to be a slight enhancement to the LLPA grid with just a 1/8 addition, because everything seems to be done in eighths, with just a 1/8 increase to whatever the LLPA grid is because you did a single score. And then that's a whole lot more than $100 on any loan.
Does the idea of a single pool, if implemented, benefit the largest lenders more than everybody else? Like Rocket Mortgage, for instance.
Yeah. I would argue that basic economics say yes, because basic economics say that anytime you have an enhancement, if you can take that enhancement to scale and scale it up, then those that can scale the most get the most benefit out of the enhancement.
Right. Fair point. Right? Now back to the other question you didn't answer.
Did you see how I just did that one too? That was.
Oh yeah, I know you well, and I know that when I asked the question, I saw the that son of a bitch face. I saw the gotcha, and then you just turned right around because that's just what you do. The other question you didn't answer was the percentage. You would not put a percentage on. I thought you were going to say 0% chance of going through, but nothing is zero, right?
Nothing is zero.
More or less in the next 3 years, that this more than less than 5% chance in the next 2 years that the single pool is less. Is a thing. Okay. All right. Cool. I appreciate that. Our talk.
Yeah, I don't think it happens in this administration. Let's put it that way. I think that there's too many other things.
All right. So let's make another assumption. I love making assumptions. We end up with a divided Congress after November. I think it's a pretty safe bet. Best case scenario for the Republicans at this point. But let's assume we're split. How do you believe that will affect housing for the following 2 years until we get to another administration? And is this something that is it too early to start thinking about this, or should we?
Part of it depends on how the split works. Is it in the Senate? Is the Senate Republican and the House Democrat, or vice versa?
I don't know. Where's that more likely to happen? You know that better than I do. I don't know. It's close.
I don't know. I mean, honestly, this is where I get lost.
Yeah.
This is where I get lost. I think that, the House Financial Services Committee has a great deal of influence over what goes on. I think that both sides can tie up the other. Well, I should say both sides can hold lots of meetings and lots of hearings and subpoena lots of people and ask lots of questions and make it difficult for the administration to advance through their agenda. So a divided Congress will certainly slow things down. I'm not nearly the expert that can to say to what effect, but it will certainly slow things down. There's no doubt about that.
Elizabeth Warren this week, she's very active. She absolutely just crushed the Fed nominee, Kevin Warsh. I don't know if you saw the.
No, I didn't see it, but I heard.
She just crushed him. He's trying to be the next Fed chair. We talked about he's got $100 million in assets, and some of them, according to her, are tied up in things related to the Trump administration and Jeffrey Epstein and all these things. They went at it, and then she went on a campaign on these various talk shows. You know them all, right? She showed up everywhere, and she said that she wants to be the party that drives down costs. The Democrats, they want to be the party that drives down costs and lowers costs for the everyday consumer. Now, that's a Democrat, and that's a Democrat who, in my opinion, had a lot to do with pushing the CFPB, had a lot to do with putting all the layers in place that had that cost to produce a mortgage go up to that close to $12,000 number, which is ridiculous. She makes a comment like that, and I think to myself, you had your shot. That's not the party that you were. I mean, when Biden left office, we were at a 30 or 40-year affordability low. So what am I missing here? Or is that just normal political jargon?
That's just normal political jargon. I mean, let's also remember that Elizabeth Warren was the big driver behind TRID. I mean, fundamentally.
That complicated things.
And, the idea behind it was to simplify things, right? The whole premise of the TRID initiative was to make it easier for a borrower to shop their mortgage and make us all compete against each other by giving the borrower a unified document, because the HUD one wasn't good enough, and then creating disclosure requirements at the front end and the back end, and they had to maintain, the numbers and then the tolerances and no tolerances, and I would make the argument that some component of that, the fact that there's no tolerance really for credit report changes as a pass through, is part of the reason we're having a lot of the conversations about credit report costs that we're having in the first place. So I don't know if I would say, I mean, look, the Senate and the House are two different chambers. They're fundamentally different. Senate has a 6-year term, and a lot of senators, are in that seat for a very long time, like 30, 40 years. So it's different from the House. It's fundamentally different from the House. I think that most people that are in politics are there to try to help their constituents. I think that there is disagreement in the best way to help those constituents. And I think that there are unintended consequences that occur when policymakers and legislators and bureaucrats get over their skis. And I think that when we take risks and try new things that we haven't fully considered and we don't know what the outcomes are going to be, I think that it is likely that there will be unintended consequences. And we don't always know how whether those are positive or negative, and if negative, how bad negative. Because I would argue that we tried this experiment back in 2000 and 2001 and 2002. Hey, let's ignore the income numbers. We're going to improve them anyway. Hey, let's ignore the assets. We're going to improve them anyway. They've got great credit scores. Let's give them all approvals because they got a 640 FICO. Look how that turned out.
No, it's a good point. Did the mortgage industry help to create the credit cartel?
The credit cartel.
I'm calling it the credit cartel. That doesn't necessarily mean you agree with me that that's what it is. That's obviously a pretty firm, big swing.
Yeah. I mean,
I call it the credit cartel because it grabs your attention. But the abuses that we see, the price increases, without naming names, I believe that the mortgage industry was complicit and that it took too long for us to speak up, and there were too many competing interests and such that we ended up getting to a spot where it was already a runaway train.
Yeah, I don't know if I agree with you. And the reason that I'm not sure that I agree with you is that first and foremost, credit is not just a mortgage thing. Like, if you've got one of these things, they probably pulled your credit report. Right. And if you're driving around in a Tesla or a Suburban, you probably took out a car loan. We pay a lot for credit reports. We have specialized scoring models that are only used in mortgage. And certainly there are a handful of organizations that focus and specialize on mortgage. But FICO, TransUnion, and Equifax and Experian, they all do stuff in Canada. And we're not going to go blame the Canadians for our cost of credit in the United States. Like, right. You know what I mean?
Yeah, fair enough. Fair enough. What are you working on at CHLA right now? Tell us what you guys are focusing on.
I'm working on my tan because I saw you and you look a little pale today, and I figured
I always look pale. I'm in a hotel room. I'm not comfortable in this environment. Okay. Don't pour salt in my wound. All right. I'm pale. I'm freckly. If I put my head down like this, you'll start to see, more white as I go down and down.
I can introduce you to a guy that'll help you with that.
I know, and you look amazing. You are one of the best looking, best dressed people in mortgage. You've not been officially named that, but there's no question when you walk into a room, people notice. FYI, and I'm comfortable in my own skin to say that. By the way,
thank you.
My own pale, freckly skin.
Not sure how comfortable I am in my own skin right this second. So I'm going to answer the question that you asked. We are really focused on first-time buyers. We're really focused on the fact that the age of the first-time home buyer is jumping up rapidly. NAR says it's 40 years old, which, there's other competing numbers that say 36 or 38. It doesn't really matter whether it's 36 or 38 or 40. People should be buying homes when they're 27 and 29 and 30. And I shouldn't say people should be, but I should say people should have the opportunity to. And we are really concerned about the fact that the age keeps getting higher, which just fundamentally means that young people aren't buying. I know that some of that is societal. I know that some of that is that there are young people who would rather rent and be mobile and be able to move from one place to another. But some of it is because there aren't homes available. Some of it is that there aren't down payment monies available. The calculus for buying your first home has changed. I bought my first home when I was 27, and maybe I might have been a little bit older. I might have been 29, but I was under 30. And, that was a good thing. We're looking at different areas that we think can be leveraged and exploited in order to make the opportunity for a Gen Z, a member of Gen Z, to actually buy a home before they're 50 years old.
Such as?
So we're looking hard at tax opportunities. For instance, we've got a couple of different proposals and we haven't unveiled them yet. So I'm not going to go too deep into the weeds on it. But, you can borrow money from your 401k and you can use that to make a down payment on a house in theory. But then there's this huge reason not to, which is that once you do, you can't quit your job. And if you do quit your job, you have to pay back all of the money you borrowed like the next day. Right. So it is a huge deterrent for anyone to actually borrow from their 401k, because then they become beholden to their employer and it limits their ability to decide to go work somewhere else where they might get paid more and have upward mobility. And we think that that is an unfortunate structure that can be remedied and that can open up the access to capital that first timers need access to so that they can buy a home.
Okay. Interesting.
Yeah.
Loving being a member of CHLA. And I have to tell people out there that it's a bargain too for what you get in return. So appreciate your advocacy, the work you're doing. I know I'm going to see you later today at the gathering.
Yeah.
In Austin, Texas. Can't wait for that. I'll give you a big hug and
a sweatshirt and a hoodie.
A sweatshirt. Yep. And appreciate your time as always. Taylor Stork, president of CHLA. Also, you have another job. You know that, right?
Yeah, I got a couple.
Yeah. How are things at Developers Mortgage?
Good. Yeah, they're good. It's exciting to see some of the changes we've put into our workflow and to see some of the technologies we've introduced into our model and the impact that it's having. So it's a lot of fun. I've got some great people that I get to work with.
Awesome. Can't wait to see you again. Hope everyone's enjoyed this one-on-one, and we'll see you again next Monday. Have a great week, everyone.
Thanks, Greg.